Hey, good morning, options traders, and happy Friday, everyone. I wanted to share with you probably one of the most important concepts for all of our new traders, and that is about rights versus obligations. And it's at its most fundamental level, that's really what the options market is about. And if you understand these concepts, it will go a long way into helping you understand strategies and risks. So what you want to understand is that buyers have rights. If you buy an option, you have some type of right. If you sell an option, however, you've got an obligation. So buyers have rights, sellers have obligations. And this is why sometimes when traders all think that it's about options selling is the place to be and talking about credits, they don't realize that they are entering into obligations. That doesn't make the strategies bad. It just means there's probably more to the strategy than they're realizing. So if you just understand these basic elements, buyers have rights, sellers have obligations, it will help you to understand strategies and also to uncover potential risks. So what are these rights and obligations? Well, here's a little grid you can jot down and you'll eventually just memorize it. But if you buy a call option, you have the right to buy the shares or whatever the underlying is for the strike price. If you buy a put, on the other hand, you've got the right to sell the underlying for the strike price. So notice that in this row, buyers have some type of right. On the other hand, if you sell an option, you've got an obligation. So what would the obligation be for somebody selling a call? Well, that can also be a little confusing for new traders. But if you can understand what the buyer has the right to buy, realize that the buyer and seller are just on the opposite sides of the trade. And so everything is opposite. If one is bullish, the other is bearish. If one pays a debit, the other receives a credit. So therefore, if you sell a call, you must have the obligation to sell. Why? Look at this. The opposite of right is obligation, and the opposite of buy is sell. The call buyer has the right to buy. The call seller must have the obligation to sell. So what about the put seller? If the put buyer has the right to sell, the put seller must have the obligation to buy. As before, opposite of right is obligation, opposite of sell is buy. So notice in this row, the sellers always have some type of obligation. Buyers have rights, sellers have obligations. So how can this help you to understand strategies? Well, let's look at a couple of examples. Let's do a long vertical spread. This means you're buying it. So let's say that you buy the $100 call and sell the 105 call. This would be buying the 100-105 vertical call spread. And of course, because you're the buyer, you will pay a debit. Let's just say that it's $3. So some questions that we have: is it bullish or bearish? What's the max gain and max loss? Well, if you understand some basics, you know that the most you can lose on any strategy is the amount you paid. So we know the maximum loss is 3. But what about these other questions? Well, here's our risk graph. And you all know by now this is one of our bends at the 100 strike, our long position. We get another bend at the other strike right there at the 105. So what I want you to start doing is looking at these or visualizing them in terms of rights and obligations. If you bought the $100 call, you have the right to buy for 100. And by selling the 105 call, you have the obligation to sell for 105. So now think about it. If you are buying for 100 and selling for 105, what's that worth? It's potentially worth $5. And so that's the most this spread could ever be worth. So let's put some numbers to it. If you paid $3 for it, and it could potentially be worth $5, the most you can put into your pocket is $2. And that's right where we are lining up. So we could also answer, is it bullish or bearish? Well, if you've got the right to buy for 100 and the obligation to sell for 105, what's the only way you could make money under that circumstance? Stock's got to be rising. It's got to be at 105 or higher. You can't buy for 100 and sell at 105 if the stock is down at 90. It's got to be a bullish strategy. But see, I didn't need to memorize that. I just can fall back on rights and obligations and figure all of this out. So fairly easy. Let's try a short vertical spread. Let's say that instead you sell the $100 call and you buy the 105. This would be the trader on the opposite side of the spread we just looked at. So here you would be selling the 100-105 vertical spread, and let's say that it's a net credit of 2. So again, is it bullish or bearish? What's the max gain and max loss? Well, if you receive a credit, that's always the maximum gain. So we know the maximum gain is 2. But what about these other questions? Is it bullish or bearish? What about the max loss? Well, here's the risk graph. So right here you are selling the 100 call, that's your bend at the 100 strike, and you're buying the 105 call, that's the bend we get there. But even without seeing this risk graph, I can just visualize that by selling the $100 call, I've got the obligation to sell shares for 100, and by buying the 105 call, I have the right to buy at 105. So now if we sell our shares for 100 and we buy them at 105, or conversely, if we buy at 105 and sell at 100, what is that? That's a loss. No way around it. There's no potential gain in this spread by itself. And that's why I tell traders to think of this as a liability spread. Now again, that doesn't make it bad, but this is why you have to be careful, and everybody just bangs on about credit spread, credit spread. Yeah, it's 6 of one, half dozen of another. It's a credit, but it's also a liability. So in this case, it's potentially worth a loss of $5. That's it. You are just simply accepting a potential loss of $5. Why would you do it? Well, because you're receiving a credit. So when you're selling a credit spread, you are really acting like an insurance company. You're saying, in this case, I'll take $2 up front in exchange for insuring a maximum $5 potential loss. So is this bullish or bearish? How would we figure that out? Well, if I'm using call options and I have the obligation to sell for 100 and the right to buy for 105, I certainly don't want it to go up because that's going to incur this $5 loss. And what this means is I would really like for these call options to expire worthless, and therefore it's got to be bearish. And again, I didn't do that from memorizing formulas and definitions. I can figure it out by understanding rights and obligations. So if we insert some numbers, we know that the credit we received was 2. It's potentially worth a $5 maximum loss, and therefore the maximum loss would be 3. So again, I just wanted to pass this on. I think it's really helpful when you're learning strategies. It'll also help to uncover a lot of the myths and misperceptions that people have about strategies. If you understand that options are, at their very most basic level, a market for rights and obligations. So if you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.